Boom! We are live, ladies and gentlemen. It's Theo and the Arcane Bear. A lot of people have been asking, what do I do when I exit? How do I exit? Where should I take profits? What should I do in the market? And these are all good questions. The problem is there is no one simple and easy functional answer for everyone and their place within the market and their objectives, their long-term outlooks, and their risk, love, or aversion. So that makes a simple answer and a succinct one a little bit difficult. So what we're going to do is build some conjecture and then take a look at Bitcoin's prices, and then as well as Ethereum and a few of our other favorites, as we generally like to do. So as we drop in, we're going to actually take a look straight to Bitcoin and retest some conjecture method here. So here we go. Boom. Yes, 4 hour. Let's start somewhere in the middle of the chart. Again, a lot of you who join us, you'll remember that right now we're looking on a pretty small time frame, considering part of this question is going to be how do we avert risk. One of the problems when we start charting is that, okay, well, we look the 4 hour time frame, look how big this drop is. It looks monstrous, right? Okay, well, if you zoom out, we're pretty high up anyways, so this was important. Now, there are different types of traders and there are different types of investors. Some traders like to move from just points of box up, bottom, and top, or for undervalued or overvalued within a trading range. And this could be extremely lucrative to do on a day-to-day basis if that's what you felt like doing with your time. Not my favorite. So here, just as an example, part of this is, well, where do I take profits? It's so difficult to boldly answer that question because it's so different for everyone. So I'm kind of building like characters to show you how each one of these players might go through different layers of risk aversion and profit taking. So first off, what we're going to do is we're going to use the 4 hour chart as an example, and we'll use the previous areas. But I'll show you the downsides to this style of trading and this type of risk aversion. So often you will find intraday traders who will buy pretty much anything below the middle of a trading range as you see a formation of a primary support and a buying climax, because you have a fairly high level of automatic rally almost every time off of your primary shakeout. And we've seen this multiple times before, and we've kind of witnessed it right now. Now, the difficulty is always, okay, well, was it a shakeout or were these the secondary tests? Because generally you would want to wait until your last spring, and even more importantly, after you've closed in the middle of the box. So this type of trading short-term mentality here, where you've got, let's say, at most an 18-day trade, and this could also be considered swing trading to some degree. Intraday trading is much more short-term. Like, I'm going to go in on this day, and then 12 to 24 hours later, you're out of a trade for what is this, a 16% move, which in Bitcoin is huge. I don't like this type of playing, yet the risk aversion is usually a very tight stop loss and somewhere around here, and the profits are in very thin margin as well. So you're usually risking 3 to say 5 or 3 to 10 for even better odds. But very seldomly do people focus on these larger time frames. And here on the 4 hour, what we're looking for are these much bigger end result moves from generally spring to SOS and then the continuation of the bull market. And here, risk aversion is a much different game plan. We are trying to make as many entries as we humanly can within the original trading range. And then outside of that, we're still making entries, but with a much higher level of caution into the way the risk is played. Now, you can also add 2 formats of what you're trying to do at the same time. So you can have a portfolio that has a long-term hold position and another 10% in it that's trying to do more, let's say, exotic plays with the rest of your portfolio. Then you have venture capital, which should usually be looked at in 5 to 10 year timeframes and doesn't even necessarily fit on this chart. So the answer to this question is very difficult because there are so many different styles to when should I take profit, when should I exit, and what should my strategy look like for those exits. For instance, Populous, which was a token I bought some of back in 2017, dropped down to almost nothing. And I didn't sell it. I just sat on it. And now it's worth like 14 times more because I had a decent entry from where it is right now. Now, that at one point was a total failure. And now there's air back in the wind of the bull market again. And we see it's huge, 1,400%. It's not a small amount of growth for something. So what's interesting is that the venture capital risk is really the stop loss of how much you're willing to put in at that moment and how much you're willing to sit on for a long period of time and not worry about how well it's done. So because of this, what I always want to do is suggest people go and study on the internet stuff. Okay, the internet stuff. What does that mean, Tio? Why would I want to study the internet stuff? Well, the internet stuff, you can just ask questions to. So what you need to know about exit strategies. Now, Fidelity has spent a lot of time putting this stuff together, and it can give you some of the basics. But again, one of the most important questions is how long you intend to be in the investment, which is basically what type of access are you taking? Are you taking a short-term intraday trade, a multi-week, month, day, or like swing trade? Are you taking a multi-year investment, whether it's through venture capital or just long-term holds in already productive businesses? And is there even a point in taking profit, especially in those longer-term investment strategies, unless it becomes an absolute monster in your portfolio, which does sometimes happen? And well, that's again up to you. How much do you feel like risking, and how much can you afford to risk while being able to maintain the businesses that you operate, hopefully, or the things that you like to do? Hopefully you have things you like to do, and how long you might need to do those before the ups and downs of your business. For anyone that's ever managed a business, you would inherently recognize most companies will have bigger bouts of selling their particular product in, say, Christmas time. Maybe they're swim shorts, so during the summertime. There's a lot of seasonal earnings, and how do you invest that? Can you budget for multi-months and multi-years? This is a great way to think about building a portfolio, is how do I budget long-term acquisitions in my investment and venture capital bags? If I am going to get into trading, make sure I know how long it takes to get good at it, because it's years to even understand some of the basics. And more than an exit strategy, just learning how to accumulate, and only accumulate, is enormous value in the market, and it actually signals that you're more focused on generating wealth alongside. You can do that with a portfolio, but you should also be doing that in your business, and I think that this is just what you do to communicate value for the rest of the world. That's effectively what I at least have a hopeful vision of business being in the future, and it kind of already is now. Maybe those stories just don't get told as often. So this idea of like how to build a sound exit strategy. So we can look at support and resistance. We do this. The profit loss and ratio. This again is really highly dependent upon, do I want to take a trade on an intraday trade moment? Is it a 3 to like 5 or 3 to 10? Like I'm willing to lose 3% on a potential of 10%, effectively by where I think I am in the support and resistance areas of these larger trading ranges. Sometimes they're smaller and you don't get that functionality. And I would much rather, just like we've done here in the last little while, focus on the macro timeframes and make more long-term investments, and then just have a different area of my portfolio where, yeah, I can play around with trading. I like options. There are some exotics that are extremely valuable for managing wealth. Just in general, in the venture capital sector, being patient is itself the toolkit that you need. And, I guess to some degree, less than I thought. You don't even need to be intelligent. You just need to make a lot of really small investments quite often. That way, the ones that you wouldn't have got right because there was no sensible reason to be in that investment, you got into it anyways in just a smaller amount. So I think finding that smaller threshold for investments is extremely important too, especially in the venture capital sector, because it is mind-boggling to me how many intelligent people just don't put money in particular areas because it didn't seem logical that would succeed, but then it ends up succeeding and could have been hugely profitable. So just limit the size in extraordinary measure. Like if it's 2013 and you find out about Dogecoin, you just buy $20 of it, not so that you can have an investment in it, so that you can learn what the fuck is Dogecoin or Bitcoin. And a lot of people hit this value threshold where, oh, I don't have X amount of dollars to buy something, so I'm not going to do it. Generally, the learning experience of investing, even if it's in a small amount, can be extraordinarily valuable, right? So this idea of an exit strategy is really built around, first off, primarily what type of investor, trader, or venture capital play am I looking at? Where's the profit to loss ratio? Again, here with venture capital, it's pretty much like to zero. That's it, right? Whereas other intraday trades, maybe it's only 1 to 2% of what I'm willing to risk for that particular moment for a potential week to 2 week long trade and then get out of. Funding rates are high. There's multiple questions that go into this. So I kind of like this. It says this 1% rule. It says provide a general rule of thumb. It says investors should set their max loss at 1% of their liquid net worth. When you're playing, if you're new to something, if you are using a high amount of of your net worth to try to learn something, you should probably scale it back a little bit because the risk is significantly lower and your mistakes cost so much less. And often, because people have this value transfer problem, not only they're not willing to put a small amount of money into something, they're also then only willing to put a large amount of money on something and like stake and bet all of it on this crazy outlandish idea. And you really want to find that happy medium of, okay, if it is a stupidly crazy outlandish idea, let's at least put some money in there because that sounds fun. But I'm going to gauge how that functions by using my intellect, but still step up to make small, tiny even investments sometimes for the learning process, and so that I can kind of play around and learn. I guess learning is fundamentally the depth of that play. But it baffles me again that, because when you're trying to measure risk, right, this is kind of this target profit loss and the 1% rule together, and even the exit strategy in general. If you can separate what type of goal and what type of performance you need in order to achieve that goal, trading is probably not your best option. Venture capital is my favorite, but it's slow. And if you want to be good at it, it involves a lot of reading, which I happen to love, or listening. You've got like text-to-speech stuff, like just click here.
E.g. Y defines the maximum amount.
Yeah, I could get the computer to do half my job. I could just get it to read this time to exit strategy, but I'm not going to do that. If you'd like to read a lot of these reports, they're out there. So what I can do is I can add my thesis on top of kind of what's already out there, just to help hopefully refine some of the conceptual aspects, because I believe that's the most valuable to you as the individual, because it means it's the framework of how you want to build, instead of like, here's exactly what I'm doing, which may not be beneficial for you, because either my risk aversion or my risk intolerance is different than your risk need or my risk need for each particular like bucket strategy, I guess. So I just wanted to kind of go over this. I thought Fidelity was a nice one, because I could say, hey guys, just go to like Google if you want a fairly textbook answer. If you want a conceptual answer, which I can give you, it is a lot more philosophical, because my wantonness to drive 180 kilometers on a motorcycle is probably much different than how you may or may not choose to do that. And I think that's a great way to understand that our risk aversion, the way we invest, and the things that we're interested in are going to be drastically different. And because of that, you're going to come up with different results. And that's important, because what you can do with information that's geared towards your own education is much more valuable than me just telling you exactly what and why and how I'm going to do something, because they don't translate necessarily. So what I'm trying to do here is make a broad enough philosophical perspective so that things translate into the multi-dimensional world of investing and trading. It's so mystical and arcane, but I like it. I like this idea of acquisition of wealth and these different strategies. Some of them are like riding a roller coaster. If any of you have played with leverage and you know what it's like to have a good margin account, it's like a roller coaster at times. You're going to be there in a trade for maybe less than 24 hours, hopefully, if you did it right. So it's much different than, did I buy Bitcoin and wait 10 years? And do I even sell it over that 10 years? Because predominantly, maybe I'm new at investing. Maybe I've only been doing this for 6 months. So the best thing for me to do would be just to continue doing what I'm already really good at, stay focused, join a groups of people, forums, whatever it might be, to stay engaged, because this type of technology is going to change the world. We're making monetary assertions of something that is, it's very clear now that is going to be the normal eventually, right? I don't know at what point it became very clear that psychedelic mushrooms and ayahuasca was going to become like the normal, but it's happening, and this is extremely exciting. So one of the reasons we want to go over and make sure we have this kind of philosophical approach to things is because it's supposed to be an individual journey to wealth. That's what I believe, at least. And that's a very different story for everyone. So don't think that my exit strategy would work for you, even if it was instantly translatable. So again, here you can do a lot of find basic stuff like market orders and limit orders and stop loss, a conditional order. How do I enter a position at one point and then have an instantaneous stop loss there if it hits? Anyways, this is extremely valuable for intraday trades or maybe week to month long swing trades. But holds almost no relevance if you start talking about 5 to 10 year venture capital plays and your ability to accumulate and strengthen positions, which is generally a much more like a longer time frame where you manage businesses that are generating revenue, and you would rather sit on assets instead of liquid cash or currency. You're better to sit on something that's going to do well, even own stock in Tesla. So first, you have to pick apart each of these types of strategies, and then you have to come up with your own risk assessment of how you would want to play those. And there is no set answer. So, one of us might be more willing to lose money than the other, and that, or the depth of that, which also makes the trade potentially functional to some degree too, or margin on an account. So there's some very complex, specific answers, but it's kind of up to you to figure out how it is you want to play that game. So that was kind of my little rough mode of exit strategies. I hope I got the 3 buckets idea across clearly, and that even though there is definable risk that you can look at for what I want to do in an intraday trade, when you're dealing with asymmetry, which is I believe a large function of exponential technology and deflationary technology, or I guess to some degree all technology is deflationary. So the sector of things that grow, scale, and then change the world should be much higher than the downside. So early entry, and again, this is why venture capital is such a strong part of my interest, is extremely important. And here we get to sideline and partner our venture capital function and liquidity within a very quick bull and bear cycle, where we've seen some of these things shoot up. Ethereum is a great example, to like $1,140 the first cycle after when it started at dollars, right? That's insanity. And it's still just getting started. So venture capital here is extremely a valuable place to be learning and growing. And I think it is one of the most opportune times for, let's say, the normal person to figure this stuff out. Do understand that the stoves are hot. If you're in the United States, it even makes it more difficult to play, but that's the way it goes. Oh, Alex Kushner, it's very fucking funny. I love that you said this. Alex says, Tio, can you do a brief chat on the market drop today based off Janet Yellen and the Fed mixes with the 10-year bond? What I love about this is I have clearly asserted my belief that when you see news, it's secondary, that it actually has no relevance to the market almost whatsoever. And what is very unique and I think conceptually interesting to me is that the markets appear to move almost before the wave crashes, generally because you have a larger group of people that are solely focused on the monetary interest of thought, like antennas. So again, the point of this, I don't think Janet Yellen talking about the bonds had anything to do with the Bitcoin market at all. If you look back at my video yesterday, I said I think we've peaked out into the automatic rally. We've hit the right to center of our channel, which is pretty much exactly where the point of control was, and that we would come back down to this. So here, if I zoom in on Bitcoin, and if you go back to yesterday's video, this return to the point of control I said yesterday was what I was hoping to see. It was just how do we move around the point of the control that I'm interested. Do we get a deep spring, or do we stay above the point of control, move up, and continue the bull market right away? So Janet Yellen saying something didn't mean jack shit, because this was going to happen in the first place, right? So I'm a better on consciousness that people aren't actually creating reality. They're just mostly a function of it. We like to think we're the thing that's creating our reality, but I think we're much more like the water droplet falling out of the crest of a wave before it falls back into the ocean. We have very little to do with how and where and why we are in this motion between consciousness, appearance of separation. If that makes sense. That's a big thought process there. But that's my core belief about the markets, for better or for worse. It seems to work. So here, yeah, we actually went over this, that we thought the automatic rally was over. We marked this out. Again, what we're looking for is that I don't know what's going to happen, but we could tell that we were getting these big wicks and smaller wicks on the Heikin-Ashi charts, that the trend was pretty much over. We've now hit the point of control beautifully. So the next question is, do we do we focus around here? So part of the idea could be, yeah, maybe the future is undecided and we do actually have some control over it. And maybe if Janet Yellen and the 10-year bond does something else, we'll have a down market. But we'll be able to see that before it happens, which is interesting to me. It's one of the Jesse Livermore quotes as well, or one of the big investors. Maybe it's even in the Bear Den quotes. I shared it on Twitter the other day. Don't remember it off by heart. But it was basically... whatever news comes out between now and tomorrow, I can show you where that will take us based off the lines of support and resistance. And that's kind of this secondary thought that we were going over, or these ideas here. It's like the support and resistance is really one of the key fundamentals of how we look at this. And it's just about where we are in the larger macro perspective of the story too. So we're not done yet, but I don't think the news is a leader. I think it's a very heavy lagging indicator for market sentiment itself. So the next part of the story here is going to be how well do we hold this 47.8 line, and do we close above 51.8, or do we close below the POC line here and then do get that spring into the March 9th through 14th area that I think we might. That's my current conjecture is that we go lower, but maybe I should just be more bullish and go, hey guys, look, we're probably going to close above the 48,000. Screw Janet Yellen, fucking puppets with their goddamn ass paper money that not worth anything. We can decide the governments aren't worth anything without us, so fuck them. None of these things should be worth anything without our choice for it to be that way. So why not? We're all choosing Bitcoin, goddammit, and we're going to decide what happens. And now they're moving, and we're going to move above the backup middle line here for this new trading range. So that would be great. Actually, both seem very likely to me. So why not just for fun go, hey, I'm optimistic. We're going up because I'm not bearish in any way. And again, this kind of goes to our exit strategy. Like, are you in an intraday trade short here? Because I don't like doing that, but that's 20% potential for downside if you got it right. So if you limit your 3% of the top of your automatic rally here for a 3 to 20 trade, looks pretty damn good. But only for a very short period of time, like maybe 4 days, right? What was that? What day is it? It's the 4th? Yeah, like 6 days, 8 hours at most, you'd want to be in that trade to see where it was going. Anyways, and with a trailing stop loss. So there's no direct answer to this. I guess that's the point. Let's see. Well, I guess, boom. Thank you guys. It was pretty much the end of the conjecture today. I'll go over Ethereum here. One of the nice things is Ethereum's holding quite well. A lot of NFTs and hype around Ethereum right now. Oh my God, Amazon adding Ethereum. It doesn't really make a difference, guys, but okay, sure. So many crazy people here. That's fine. Yeah, adding Ethereum to Amazon makes any difference. Jesus Christ. This is ridiculous. I don't think people know how some of this stuff works. but fine. That's fine. You can get excited about that. I'm not that smart either. Let's be very clear. Like, I don't consider myself to be the sharpest tool in the shed either. I don't even consider myself to be, I'm like, whatever. Anyways, next thing. Anyways, that was my very short conjecture on Ethereum. I like that it held up strong here. That was good. That's nice to see actually after that shakeout. It's nice to see that it held up strong there and didn't drop below our support ranges. That's good. That's a good sign. Link had a very nice bounce off our previous support area, up 34%. And again, still showing some nice strength, although, or at least buying support. I think Citibank came out and said that Link should be worth more than Bitcoin or something ridiculous. I don't see how that's the case. But Link definitely has value as an oracle. So this is a little worrying when we saw these big spreads with very little supply coming in. Again, if you join us every day for the Tiho Learn Something from watching the markets videos I do all the time, this supply injection here and this significantly larger price spread is a little concerning. But again, we're right in the middle of this. I think we're like 11/16 the way through the bull market. Maybe we're 10 3/4 and 11/16 the way through a 34th bull market. Anyways, I don't know. I think the point of that is to say I'm not actually sure, but we are looking for distributional patterns, right? So one of the things is we know we're high up in the markets because both Chainlink, Ethereum, Bitcoin were all high up in the markets from where we started in March, right? So to be cautious, and And again, when should I exit? It's like, well, that's a very difficult question. Depends on so many different types of variables. So I have no easy answer for you there. Is really, you got to come to your own conclusions to that. All I can do is philosophically and conceptually give you the different the different areas to look at. Not much more valuable than like at this price, I'm going to close out this much at this particular day, because it can change on that drop of a hat depending on what bucket it is. But anyways, with Chainlink here, we're quite high. So these are the first large distributional patterns that we saw, and with less supply come in. So even back here, this particular move from $19 back down to $7, that was a big one too. You had a nice price spread, 66% price spread on Link, before we found a new trading range here. So even from that drop of the trading range, we were still up to 300% since that drop. But this spread, this primary spread here, was 40% and had a crap ton of supply come in. And here we dropped. Here we dropped more. We dropped almost 41%, and a very, very limited supply check came in here. This is the first really big sign of weakness I'd seen for Link. In most of its bull market, if not all of its bull market. Like even here, this big drop, which is again only comparable to where it was around 65% as well. And look at how much supply came in for that here. So we're starting to see weakness in the supply test, and we've seen that with Bitcoin. It's the first time we've seen it with Ethereum. Bitcoin actually has not showed that yet, other than these two kind of co-aligned trading ranges, which have kept look like perfect stair steps. Basically, they're like megalithic sized stair steps of perfect laser cut pre-Younger Dryas granite. Some of you will get that joke. Okay, so where we are in the markets right now, looking very bullish. Everything is looking great. Maybe we get a spring down to 40K. Maybe we stay above the point of control here at 48,000. That would be great to see. Either way, we're bullish on the long term for the rest of this position, looking for somewhere between 150 to 280,000 to top out. These subtle signals that we are learning more about on a day-to-day basis, these distribution patterns, or at least micro distribution, as we call them in the private group, where the amount of supply and the price spread starts to come in. Again, here the change between Ethereum so far. The depth of this spread is important. So this is study for the next leg, which is the finality most likely of this bull market, where we go quite a bit higher very quickly, and we're going into strength day over day over day over day with very little stopping for probably, let's say, 30 to 90 days. It's just going to feel crazy. Everyone will be buying Bitcoin. Every single person will try to find a way to buy Bitcoin or something like Bitcoin. It'll drive the whole market into total insanity. And it'll be fun. It'll be very euphoric. And the exit strategy there is kind of up to you. It really depends on how and when and what type of bucket you're playing with. You know, there's we've gone over multiple videos where some of the best things to do is to just only buy and only accumulate. And I think that's a very good strategy for new investors. Even if it is a fair amount of money, you should be focused on generating more wealth, not necessarily selling to double down to become a good investor in year one. Chances are you'll actually lose and do worse. And I know that's a hard pill to swallow, but look, I taught and played drums for a bunch of years when I was younger. Not that I'm that old, but if you give a student unrealistic expectations about their ability to perform within the first few years of them playing, they often give up. And what you want to do is remove barriers so that they have a better time. And one of the barriers to being a good investor is to just accumulate and not worry about exiting at all. Because when you first enter the market, you have such a little understanding of how it works that you're going to make so many mistakes that end up costing you a shit ton of money that you could have just been in the market always buying while you're going to your regular job or whatever it is you do that's not investing, and continue to generate money that you can invest and actually spend on buying more Bitcoin instead of like, I'm going to buy it here, I'm going to sell it here, I'm going to buy back in here. Because often the mistakes that you make in that first year or two because of the emotional lack of training you have to understand that emotional roller coaster you have to go through can cost you an enormous amount of money when you could have just been accumulating. So I go over these trading ranges because there's such a large genre of difference, or let's say a large spectrum, the eclectic nature of everything pretty much, but a very large spectrum of how much wealth someone is generating, how much they can manage, and the importance of this information, no matter how much money you manage and how much money you have. But it's really about that style, coming to a very solid conclusion for where you sit, and accepting where you are in your learning process so that it can be as enjoyable and as hopefully lucrative as possible. And for the early stage investor, let's say your first 3 years, you could literally just focus on accumulation and continue to study and read books like a gangster, somewhere like 10 to 25 books a year, 40 to 50 scientific papers, or at least like voice read, again, medical lectures, whatever it happens to be. Just, stay up to date. To become a better investor, because a lot of it is patience. A lot of it is still just accumulation and more patience, especially if you're generating wealth. You don't need to try to sell the top to buy back into the bottom. You can just shave a little bit of profits to go, okay, well, I know what I would like to do, the things I would like to increase. I had a great year this year. I'm going to blow all of it. Do whatever you want to do with your money. That's up to you. And that's really the risk aversion and the profit loss strategies that are most beneficial are the ones where you can assess that. And there is no if this, then this answer. If there was, it would be more programmable, and it's not. Some of the people that have been extremely successful are successful because they do silly things, and there's no programmable risk adjustment when that happens, right? So you want to practice and study, I think, on a more consistent basis than just focusing on trading, especially in your first 2 to 3 years. You want to be learning, and that's like that's how you invest deeply. Is just try to accumulate as much information as possible, and don't make decisions based off that. Kind of what you're. Oh dang. Based off what other people are doing, but what fits you the best, because you might come across something that no one else would have and then not done it because you were listening to someone else instead of practicing your own skill set. And that's why I always try to make these as broad perspective as possible. Okay, someone just dropped in a super chat. Travis333 says, "What's up, Tio? Beautiful insights as always, and I'm wondering if the tech team knows anything about PokeStarter for VenCap. I haven't heard them say anything, but I will ask." And Travis, I think you just kind of highlighted my point brilliantly, right? Let's use Travis's comment as an example for what can we learn from this question, right? So I appreciate the compliment, but we're looking for what tech team knows about VenCap. Let's ignore tech team and go, okay, well, what does Travis think about PokeStarter? Because I have clearly missed things in the past because I thought I knew better. Whereas I think the point and the value of a question like this, from when I'm looking at what can be learned and gleaned from, if tech team doesn't know and I don't know, well, how much risk are you willing to put into PokeStarter as a venture capital play? Because right now, what's crazy is you could put in $5, you could put in $10, $100, $1,000, 10 grand, 100 grand, $1 million, 10, $100 million. Well, you would start to really push the markets the higher you go, and then you know more about what comp man looks like. But the point of this story here is, how do you assess your own risk for the venture capital play that you're willing to make? I think we should probably all be making a lot more smaller investments just for fun because of the education process that goes along with a little bit of skin in the game. I could tell you that if right now I'm like, okay, here, I could even give an example. Travis could send me PokeStarter, and I would then find out that it's an ERC20 token. And I'd be like, well, damn, Travis attached a memo because where did this random thing come from? And I look, he's like, well, research PokeStarter. I'm like, now I'm like 5 minutes in. I'm like, okay, well, I'm researching PokeStarter now. So part of it is the value, not that comes from your investment, but the value that comes from your own focus on the fundamentals that you think are interesting, because you might recognize something that we would miss. And that's so important. So this type of objective, I think what's valuable here, Travis, is how just start as low as you can go. What's your $10, $100, $1,000, 10 grand? Start somewhere, make that investment, and then you will start reading more. You will start paying more attention, even if it's only a small amount of money. This is why I suggest books like Nassim Taleb's Skin in the Game, just understanding your relationship when you are actually playing. And then the importance of not trying to win everything all at once, right? Like, oh, I'm going to make $1 million if I have X amount of money in VenCap PokeStarter alone. So I'm just going to put $10,000 in there. Or how am I $10,000 confident about it? Or I'm like, maybe $1,000 in there sounds great because I will totally forget about it and I won't have to think about it and I won't even barely have to read. I'll just look, I'll vaguely check it, like, cool, that's a great idea. Wherever that size fits for you the best, especially on the 5 to 10 year outlook, fantastic, because we will go into another bear market and the bear market will reassess the value of PokeStarter then. And that's a much better time to looking to add much bigger positions. So if I were to want to increase my position on a venture capital play, I would wait till the bear market shows up. We're early enough, we're like right at the end of this, but we're still in the earliest stages of it enough where some of it might not come back down this low. And if it does, it'll be freakishly close to this low. So it could be all gravy. So it's like not still good entries for some things, right? If you know how to value and fundamental invest as well. So I think this is a broader spectrum perspective about what do I think, or what does tech team think about PokeStarter, is use this as the opportunity for any number of you that are out there right now to go, well, let's maybe just buy, or not financial advice, but maybe just buy whatever you feel, just buy a little bit, so that 5 minutes that you spending $1,000 on something at least gets you to read the paper before you buy it. So you're like, okay, at least I read the PokeStart paper. And now no matter what it does, I'm part of its growth opportunity. Or maybe I go, you know what? We're still in the middle of the bull market. I don't feel comfortable having even $1,000 in this goddamn thing because I don't know what's worth what right now. We are inflated with the hundreds of billions of dollars most likely. So how about I go not do that right now, but I'll still put like $100 in, just so that way, no matter what happens, I've got some skin in the game for the random crap that takes place in this market, because it's been extremely valuable before. And that to me is worth it because I'll never think about that $100 again or $1,000. Again, finding that modality of can you afford to not think about again as a venture investment is a really smart game plan. And sometimes you can cut checks like that up to 50 grand. Because you're confident, then it's not the case, that you're not going to sleep, that this one is not like a dead sleeper, that it has momentum over the long term. Avalanche, no, just kidding. Bitcoin, yeah, definitely Bitcoin. So keep that in mind. I hope that was valuable for you guys today. I really appreciate the measure of understanding here. If you get into life-changing wealth, for yourself, when we're near anything over pretty much 70 to anything over $70,000, I think you can. I'll shave a little bit here and there just to make sure I'm capturing some of the strength. But ultimately, I will never be removing a full positions. I'm just way too personally invested about my interest in why this stuff is so cool to me, and really why I fell in love with it to begin with too. And just before I jump off here, Travis drops a $10 super chat and says, just wanted to throw this out there because it could be really cool but PokeStarter is a coin as well as a pool launch pad for ICOs where you can get into coins pre-Uniswap or larger exchanges. Nice. I love this kind of stuff. There are a few areas we've been looking at this as well. The downside is the legality, but that's a different conversation. To the fun part, again, right off the bat, I like ideas like that. That's one of the reasons why I talked about Binance Chain back when it was $20. I like these launch pad for venture capital ideas where you can be rewarded for staking liquidity on the pool and you can launch pad. Although the problem is, I don't know. No problems. I like these ideas. No matter what, again, I like these ideas. From a venture capital perspective, there is no problem. There's just really the limit of how much you think you should be putting in there based off your research or lack thereof. I mean, again, at this point, even investing on the information or the lack thereof, just in smaller amounts, I think seems smart because I can't read everything. I can't keep up with everything. It's impossible. But we're going to try to do that because of the support of the private Arcane Bear family. We are working to bring on new writers and content creators to help develop our focus into this venture capital sector because it is my favorite aspect of this area and the things we love to do with our marketing budgets, which is helping others. So the more we grow, the more success we bring in, the more we can spend marketing budgets on doing fun things like helping other people. So this is fantastic. Thank you, Arcane Bear family, for the support today. I'm not going to look at too many other things. And yeah, we'll go from there. And again, do your own homework. Yeah. Do your own due diligence. But more importantly, be patient with your learning process. If you're new here, don't expect to get it right the first time. So really try to use your study time and take into account some of the more deeper qualities of personal wealth that you can develop while reading anything, actually. So thank you guys. See you on the next episode, which will be tomorrow. Yeah, that's right. An episode every day. We're like, this feels like we've been doing this for years already. It's not easy, but we're going to do it. We'll see you on the next episode. Bam.